Hey guys, in this episode of Pathways to Wealth, I have a really interesting and impressive guest, Todd Tresidder of financialmentor.com. Todd became financially independent at the age of 35. He sold his hedge fund that he was trading in the late 90s and then built up a real estate empire in the early 2000s and sold before the market crashed. You know, you hear a lot of stories of people that are like, yeah, I was in real estate and then I got crushed by the bubble. This guy has timed markets really, really well. And he now has built up a really impressive mentoring practice and coaching business around financial planning and retirement. And there's a lot of people out there that talk about retirement and financial planning, but Todd's one of the guys that I actually respect and that really knows his stuff and has proven that his framework actually works. And so in this interview, he's going to talk about, how he timed those different markets, the different asset classes like paper assets, like stocks, real estate, and business, and kind of how he, through our conversation, you understand how he has timed each one. And, I like to listen to this interview a couple of times because, what seems like a very casual conversation, he's actually just dropping incredible knowledge bombs. So with that said, here's Todd. All right. Hey, everybody. Welcome back to Pathways to Wealth. I'm your host, Chris Dunn. And in this episode, we have Todd Tresidder, the founder of financialmentor.com. Todd, thanks for being here. How you doing?
Good. Thanks for having me on the show, Chris.
Yeah, awesome to have you. So I've actually been following your site for several months now, and I just love your content, about financial planning and kind of the pyramid that you have set up of, to help people achieve wealth. And I even
But
noticed—
it's not a pyramid scheme. Let's be clear to everybody. It's a
not
pyramid like you'd have on the back of a dollar bill, not a pyramid.
exactly. You sign up 3 people, and then those 3 people sign up 3 people. No, so I love your philosophy, and I know on your site you even have your definition of true wealth, and that's something that I really like to hone in on and focus on. Todd, why don't you go ahead and fill everybody in on your background and kind of what you think everybody should know about you?
Well, my background is hedge fund investing, specifically quant. So all statistical market timing risk management methods in the financial markets. I sold the hedge fund in 1997, 98. The reason I give it a 2-year period is because there was a payout over a period of years. And then I went into real estate investing. At one point, I had, I was trying to diversify my portfolio. I had 160 apartment units, had a bunch of houses, had a bunch of land. I had a company that got houses on and property on back taxes, just for the back taxes alone, working in the tax lien system. And then I had, more conventional real estate investments. Got really uncomfortable in the kind of 2005, 2006 period. Every person that was coming to me wanted to get rich in real estate. It was really bubble. I was having a hard time even finding qualified tenants for my buildings because basically anybody who could fog a mirror could get a loan, a 30-year fixed rate loan. I mean, it was just crazy.
Yeah.
And so I started selling, and I sold everything. I sold every last piece of property I had by the 2007 top. It took me about a year and a half to sell everything.
Where were those properties?
They were out through the Midwest mostly.
Okay.
You
And
know,
all
so,
multifamily, or kind of a mix between that and single?
mostly multifamily. The stuff I got as single was through the tax lien system, and I got some large tracts of property through the tax lien system as well. But mostly multifamily. And then so I sold everything, sold the tax lien business. That's a whole nother story in itself. And the only house I had was my personal residence during the downturn. So anyway, I guess that's it. So basically, I'm quant investor on the paper asset side. Love real estate. Learned some lessons, good and bad, and I'm an entrepreneur. I've been a serial entrepreneur since childhood.
Nice. So what happened after you sold out of real estate? What have you done with your time since then?
Built Financial Mentor. So that was part of the thing. I got really uncomfortable with financial leverage. I felt financial leverage was an accident waiting to happen, which turned out to be true. I didn't realize how good my timing would be because it's, you really never know. I just knew I didn't want to own leveraged real estate assets during the downturn. I wanted to unwind it before the downturn. And I didn't care if I left some money on the table. I just want to be done. But it turned out it was almost the exact top. That's luck.
Nice.
And then what I've done since, part of the whole reason I did that is I really wanted to build Financial Mentor, which is my site, financialmentor.com. And the whole idea behind that was I wasn't okay going to my grave without having given it my best shot. I had it as kind of a cute little boutique coaching site since 1998. And it had always ranked for terms like financial coaching, money coach, key terms that would fill a coaching practice. And I'd had a nice little boutique coaching practice. But I got introduced to WordPress, a few years too late, but nonetheless, got introduced to WordPress and realized that I could do this, that I could actually build this kind of dream I had. And so I started doing it. I've been doing it ever since. And so that's what I focus on. I'm focusing on time leverage, technology leverage, different types of leverage, and not having financial leverage.
Nice. So I want to talk about Financial Mentor, but I want to go back to your days as a quant trader. What were you trading, and what types of trades were you taking, and what did that look like when you had your hedge fund?
Yeah, I'd be deemed a position trader, so there are positions that could run upwards of months, rarely over a year, but they would run upwards of months. Rarely were they short term. They would only be short term if they were losers in a big way, because the risk management would kick in and it would unwind the position. Mm-hmm. So, I was trading pretty much everything. So back then it was mutual fund switching, and it was before the big mutual fund marketplaces like Schwab and all these other ones where so it was all inside of a platform. So you'd have an account inside of a mutual fund company and you could trade their funds within there. And this was before the days of Elliot Spitzer, our great vaunted man of ethical genius, who then got taken down by prostitutes. Yeah. He's the one who got the bad name on market timing with mutual funds. But, we were doing very ethical stuff. It was all within the rules. We weren't breaking any rules. So we did that. I'm one of that rare 5% that traded commodity futures profitably. I had some commodity futures type stuff. Probably the only thing I haven't done is options. I haven't really worked with options much, but I did futures, stocks. I had a long short equity market neutral fund.
Okay. Did you trade electronically, or were you was this prior to the e-minis?
Well, no, e-minis were in existence.
Yeah.
So, yeah. So, I was at the bridge time. So all that stuff, the electronic platforms and everything were becoming prevalent. So, I did a lot of stuff in the early days with phone, and then, moved outwards. So it was.
And was it fully automated, or were you manual?
My methodologies are, no, I don't inflict any human judgment whatsoever. All the human judgments in the development of the methodology, I don't put any of my own personal stuff in between me and the management of the money. If I did, I'd be broke by now.
Yeah. So what's your, let's give everybody, your overarching philosophy when it comes to building wealth, and what is Financial Mentor about? Or is there a theme that you have that could wrap everything up into a few seconds?
Can you wrap this up in a neat package, Todd? Probably not really. Where it came from, I was financially independent at age 35. Anybody looking at a camera now can see I've got a gray beard and gray hair and, all that. I'm clearly a lot older than that now. So this is, solid 20 years ago that I was financially independent. And it was unusual, and people want to know why. How'd I do it? What was so different? And it was, you got to go back in time. This was the go-go days of the stock market, and this is going up into the 2000 top. It was 97. And people were going nuts. The NASDAQ was going crazy. The internet bubble was on, and everybody wanted hot stock tips. And, I just would curl up in a ball, and people would, hit me in a cocktail party conversation and think I was some big trading genius or something and had all this stuff. And it's like, no, you're not even looking at it right. They didn't even have the basis from asking reasonable questions. And so I would avoid everything. My wife got really tired of it. At one point, she's just like, why do you give these standoffish answers? Why do you avoid these conversations? She said, you spent all this time figuring this stuff out. It totally worked. It changed your life. Why don't you help some people with it? And so About that time, I ran into a guy named Corey Rudel, which most people don't know that name now, but he was one of the early pioneers in internet marketing. And I saw one of his first presentations, and he blew me away with his understanding of the internet and what it meant to our future. And
Mm.
this was back in like 96, 97. And I was just like, wow, this guy, he painted a vision that really blew me away. And so that's when I got Financial Mentor, obviously, to get that URL. That was a long time ago.
Yeah.
And so I opened the doors on that and just did a little boutique coaching practice and just trying to figure out, could I help ordinary people produce extraordinary financial results? And it took me a while because I didn't realize how much I had assimilated and how many assumptions I had in my own understanding of the stuff. When you take, it's one thing for you to do something yourself. It's another thing to be able to teach people how to do it from broad cross sections of life and turn it into a universal system. And it took me years before I developed what I now call 7 steps to 7 figures, which is where the business is going now. I'm turning it into a product-based business because the coaching long since sold out. I don't have any space for, clients or anything like that. And
So
so,
you're trying to leverage with products so you don't have to do the one-on-one time thing.
yeah. I mean, from a businessman standpoint, you could use that language. I like to think of it as I'm trying to help more people at a better price point, and
Mhm.
through leverage, I can afford to, by putting Todd in a box. Essentially, I'm trying to put Todd in a box, right? I'm trying to get the stuff out there in a format that delivers more efficiently so I can get the knowledge to people at a better price point and reach more people, serve more people. And yeah, that's a smart business plan too, as well.
Yeah, absolutely. I love that. And you talk a lot about leverage, and I get the sense that you don't like financial leverage so much, but you do use that word a lot. What does leverage mean to you, and why is it important?
Well, leverage is getting more greater results, more better different results with less of your own stuff. Whether that's time or money or whatever your resources are. It's how to get more results. So you leverage the time, money, technology, network, whatever it is, knowledge of other people's resources and other resources outside of you. And that's how you produce more with less of your own.
Nice, nice. Um, Now, whenever it comes to retirement, I feel like a lot of people my age, millennials, are just kind of clueless. That we lived through the 2008 bubble and financial crisis, and a lot of people don't trust financial advisors, and they don't have a plan for retirement. What would you say to somebody who's like in their 20s without a clue where to even begin to save for retirement?
Well, I have a post on my site that's retirement planning checklist for any stage of life, and it's free on the site. It's not a pitch or anything. It's just right there. And I actually break it down by age groups. And so, in the age group you're specifically saying in your 20s, the main thing is just work on your earning capacity and work on controlling your expenses and finding happiness in a lifestyle so that you build this gap between spending and saving, or spending and earning. And then focus on your earning capacity because that's going to have your highest return, right? So because then you got a whole lifetime for earning. And it's a lot easier to save a whole lot of money when you make a lot in the first place.
Mm-hmm.
So like if you're pulling nice mid 6-figure income, it's not that hard to save a high percentage of that income. And if you look, there's another post I say called How Anyone Can Retire in 10 Years or Less. And all it is it goes through the mathematics of how money builds up and what savings percentage results in how long until you have enough to support your spending infinitely. And it's really just straightforward math. I mean, everything I teach is all engineered approaches. It's not voodoo or woo woo or anything like that. It's all engineered mathematics, and this is how it actually works. So anyway, for the long answer to your question is focus on your earning capacity and build a gap between spending and earning and start saving and start compounding. And goes into the compound wealth equation, right? There's a terminal wealth equation. And the early stage of that terminal wealth is governed by your savings rate as a percent of your income. And then the latter stages is where your return on investment net of inflation is the determining factor.
Mm.
And so the second piece that people want to do is they want to start developing their investment knowledge but first work on your earning capacity. Really develop that earning capacity, get that gap so you increase your savings as a percent of your income.
So make more money and save more money. And then when you have more money, you can invest more money.
Yeah, then start learning your investment chops and do it with those early savings, right? Like don't think, oh, I'm just going to delegate this to my local financial planner down the street, at the such and such office. I'm not going to name names because we don't want lawsuits. But don't think that's how it's going to go down. Recognize that you're going to have to be self-responsible for your investing, and you're going to have. This is one of the insights I had very early on, was that if you want to be financially independent, truly financially independent, then you have to become an investment expert. You have to know investing.
Yeah, I agree. I mean, it's not something that you just want to trust a salesman to do for you. Um, what does financial independence mean to you? I think that can mean different things to different people. Does that mean having enough money to never work again, having enough cash flow to cover your expenses?
Passive income exceeds expenses.
Keep it simple.
Yeah, well, I mean, think about it, right? Your passive income from your investments and by the way, investments is a term I'm using loosely, right? I mean, there's three asset classes. You've got business, business ownership, business entrepreneurship. You've got real estate, direct ownership of real estate, and you got paper assets. So those are your three asset classes. The income that any of the combination of those three throws off that isn't requiring your time to produce it, we'll call passive income. It's not totally passive, right? But it allows you to have the lifestyle you want. When that number exceeds your expenses, you're infinitely financially independent. And the other thing too is you can then take it up a notch and say, when it covers your expenses and it throws a little bit in for continued savings growth, then you're really in a good position.
Then it's like perpetual growth.
Yeah. And then the other thing too is if you can do it where it comes from a variety of sources so that you're not dependent upon any one source, that's much, much better as well.
Nice. Is there an asset class that you think is good right now, or regardless of timing, good for somebody to start with?
No, I don't think that, there's any one specific answer. They're all different for different people that have different skill sets. It's something I teach there's a course I have. So I said 7 steps to 7 figures. There's a course I have called Step 3, which is designing your own wealth plan. And in that course, it goes through the characteristics of the asset classes and matching them to your skills, your abilities, your interests, so that you choose the correct asset class for your strategy. So let's take an example. I've got a client who's an anesthesiologist, right? And the guy's producing $500,000 a year. And, he comes to me thinking he's going to go raise his income through business entrepreneurship and stuff. And I'm like, no, let's just focus on the investment side and translating it from your current income over to the asset category. And then there's ways to get better translation, better tax advantages. There's ways to compound that money better, but you've got a long road to harvest if you think you're going to outpace your anesthesiologist's income. You're far better off just clocking more hours as an anesthesiologist. So that's example of a wealth plan for somebody in that position. And then, I had an attorney who come to me, and he had a very large, successful practice, large staff, and was paying out quite a bit of money in office space. And so part of his wealth plan was he bought a large office complex of which the firm itself guaranteed the rent on the full square footage. They basically took the lease on the full square footage. So he personally was guaranteed the income harvesting out of his firm. And then he subleased out amounts of it to take the pressure off the attorney firm. So it was heads he wins, tails he wins. And that property alone was enough for him to retire on.
Really? Wow.
Yeah. Yeah, so that's an example. And then in the meantime, he's doing all the traditional financial planning as well. But that was a no-brainer, right? Because as long as he's going to be in business as an attorney, and he had, a long-term time horizon for that, as long as he's going to be in that business, that real estate was going to work for him. And the way he did it, he had enough money going through the firm that the banking relationship gave him an extraordinary loan on the property in order to keep his banking business. So that was a rare example of a commercial loan deal coming through at a really good value.
Nice. So it sounds like, it's definitely a personal thing. And whenever you're talking to people, or I guess evaluating somebody's situation, is it more about where that person is in their time horizon in life, or market cycles, or like their personal opportunities, or like all of the above kind of wrapped into one thing?
Yeah, it's all the above, because like the attorney example I gave you was in Texas, right? And so Texas real estate was a good value at the time that this decision was made. If he was in San Francisco, I don't know that decision would have been as much of a no-brainer, or New York. So you've got to look at the various dimensions of it and make sure that each piece of the puzzle makes good business sense. It's not, It's not cookie cutter, but there are principles. The principles are universal. I mean, it's not complex either, right? You've only got so many variables, of which you named most of them, right? But you've got to look at the client's resources, skills, abilities. You look at where they are now, you look at where they want to go, and you map out a path to get there, to bridge that gap. I call it bridging the gap. You've got to figure out a plan to get there, and you've got to tie in their resources and what they're doing in that lifespan to do that. And you've got to engineer it all back with numbers and make sure it works. And you've only got 3 asset classes to work with, right? You got paper assets, real estate, and business. And so it's not that complicated, but you got to do it right. And what's funny is, I've been doing this for 15 years with people, and I've been doing it this way forever, because to me, it was just logical and obvious, right? That's the way it's got to get done.
Yeah. You had the framework. Yeah.
Yeah. And so I've been doing it with clients forever. And I did a marketing class one time, and I went back and I was supposed to interview past clients and find out what they loved about working with me, right? And I kept hearing about my wealth plan. I kept hearing about this wealth planning process I took people through. They'd go back and they'd say, I'm still working off it, Todd, and I'm still producing results. And I showed family and I showed friends, and they've never seen anything like it. And I was so close to it, I had no idea. To me, it was just like an obvious. This is where I started with every client. Why wouldn't you do it this way? Of course, that's where you start.
Right. So what's the biggest, I guess, challenge or hurdle or mistake that people make when they're trying to become financially independent?
Wow, is there one? I think risk management, would have to be, if one had to bubble to the top, it's not being prudent about risk management. Let's be honest about this. Be brutal honest. This is not easy, right? It's not complicated. The principles are simple, right? You make more than you spend, invest the difference wisely. Everything you know about wealth building, one sentence: make more than you spend, invest the difference wisely. Okay, so that's everything you know about wealth building. So it's not complicated, but the devil's in the details of how you implement every one of those, which is make more, spend less, invest wisely.
And don't lose it.
Yeah, now it gets interesting, right? And so now you go into this principle of risk management. And what I found is that everybody has hardship, everybody makes mistakes, we all have setbacks. And what really distinguishes people that succeed is they manage the risk when everything goes wrong, so that they can make higher highs and higher lows. So they're progressively compounding and growing with consistency. And it's that consistency that produces the results. So anyway, I think if there's one thing that stands out, it's not being prudent with risk management. That's the big mistake.
And whenever we talk about risk management, are you talking about like when you're in a trade and you have a stop loss, or are there different types of risk management that you think most people should be paying attention to that maybe they're not?
Well, yeah, this goes back to each asset class. The principle is universal. I mean, again, I'm going to sound repetitious, but that's because this stuff is not complicated, but you just got to know what you're doing, right? So the principle of risk management is universal. It's built in the math of how wealth compounds, right? And so what it is that losses and gains are asymmetric to the compounding equation. And so it's like a 50% loss requires 100% gain to get back to even. Whereas a 10% loss only requires about 11.1% gain to get back to even. And so what happens is it's asymmetric. The larger the loss, the bigger the difference in the gain required to get back to even. And the numbers get out of control once you pass about the 20 to 30% loss range. And so this is just built into the math of how everything compounds, whether you're growing wealth in real estate, you're growing it in business entrepreneurship, or you're growing it through paper asset trading. It's all the same thing. And so the principle is universal. How you apply it's different. So in paper assets, yeah, you could have exit points, right? Stop losses. In real estate, for example, when I was doing the apartment buildings, I was buying them with non-recourse financing. So each one was held in its own entity, right? Each one was a standalone business. And then my downside was limited to my down payment or whatever funds I chose to put into it, because the only recourse the lender had was to the property itself. And so that was a form of risk management, that I protected my other assets, and I insulated each building from the other buildings, right? So that would be an example of putting that into practice. Because see, with real estate, you don't have exit, right? Because it's a joke in real estate. Real estate never goes down; it just goes illiquid, right? Right.
Yeah.
That's an old joke. Now nobody catches it, because everybody knows real estate does go down. But if you go back 10 years, nobody believed it could go down, right? And so the joke was real estate never goes down, it just gets illiquid. So the point is, you don't have an exit discipline with real estate, because when the market gets hammered, it gets illiquid. You can't just dump it. And so you have to manage your risk in real estate in different ways. So that's just recognizing the characteristics of each asset class. Business entrepreneurship, that's how you manage risk, and that's going to be unique for each business. But the principle is going to be the same. And so you just have to look at each piece, figure it out, and figure out how to constantly compound and grow and control it. So like in Financial Mentor, as an example, I don't have huge downside risk because most of it's my time and my costs are extremely controlled, and the margins on each sale are almost 100%. And so that's part of the reason I built the business is, I don't have to grow the wealth. And so the income is very nice, but I don't want to do something that jeopardizes everything I've already created.
Right. So let's talk a little bit about Financial Mentor as a business and kind of what that looks like. I think it's really interesting that you got that domain so early, I guess, compared to, like that domain now would be insanely expensive. And just looking at the site, I mean, you've built the content really, really well. And it seems like you've got your funnel down. Like, what do the economics look like? What's your funnel like?
Well, I'm not sure what you mean by the funnel, because it's actually kind of in transition. There's multiple businesses inside that business if you really dig into it, right? Because you've got revenue stream off the calculators, which is a source of traffic. So it's revenue producing traffic. You've got the original conversion process, which was to coaching, which was highly effective to the point that, I was way overbooked on the practice and had to shut it down. And now you see the funnel getting redirected into the 7 Steps to 7 Figures course series, which is where the whole business is going. And the coaching will eventually be a high-end back-end product or whatever. I have to figure out what I'm going to do with it. Gotcha. So, I'm not sure if I'm answering your question. There's multiple ways in which it's structured. Basically, people come in for free through the free newsletter. I give away free bonuses. I give away a free course and a free ebook. And that's just a relationship building tool, right? They're real products, real value. And it's all given away. And then that builds relationship. I get a certain following. And then eventually they convert to a paid product if they want to take the next step.
Yeah. I love it. I mean, and you did answer the question. It seems like you've shifted from, kind of the one-on-one coaching to productizing the 7 steps. And yeah, I mean, I love how you've ranked for a lot of like really important keywords, and yeah, you've got just a really, really nice layout. I want to talk a little bit about.
Yeah, I think here's a funny sideline. Just throw something in there. The way I look at it is I've done the 80% that produces 20% of revenue. Now I'm finally doing the 20% that produces 80% of revenue. I spent all these years building the platform, and so now it's a solid platform, right? There's, it's got 6 figures of traffic monthly, and it's got, all these different things going on. And now I'm finally building the products. So it's like I did all this work and I had nothing to sell anybody. It's just like the most stupid thing, right? But I had the luxury of doing that. But
well, it's funny. A lot of people try to do it backwards. They try to build products without having any foundation or any traffic. So once you have the traffic, productizing and turning on the money can be easy if you have the right products. But
oh yeah, I mean, just to show, I inserted 2 or 3 sentences in red on a totally junky sales letter. I mean, the copy is good, right? In the sales letter, it's for the step 3 one. If I don't know when this is going to be published. Probably by the time this interview is published, the step 3 sales letter will be all designed and formatted, because I have the finished design for it. It's just not implemented, right? That'll get done pretty soon. But anyway, so it's just text only, right? No buy buttons, no ability to buy it whatsoever. And I put like 2 or 3 sentences in red ink at the top that just said, hey, I'm going to put together a founders group. I finally got this course available. If anyone's interested, email me. And this is the price, right? Yeah. So, I mean, I violated every rule, right? There was I made it hard to buy. There's no promotion. There's no design. It looked unprofessional. And within a week and a half, it was sold out. And a lot of it was cold traffic. People didn't even know me. People were just stumbling on it, saw the red ink and wrote me immediately.
Well, I think a couple of things, probably the reason why is the site gives trust, right? Like you have the content, like it doesn't look like a cheesy, like salesy thing. Right. And that's interesting though, that you said like the traffic was cold though. Did you mail your list for that too? Or is that just mostly?
So this is a good story, right? So I mailed the list an article. So I'm always about trying to add value, right? So I'm not going to just mail a promotional piece. So I sent an article, and in the article, I added some sentences and read to that one as well. It was in the article that just said something like, hey, I'm finally going to go live with a course here coming up. And if you're interested, go over to the sales letter over here, right? Which then had the couple sentences I read in this rough draft. I just thought, let's just see what happens, right?
Yeah.
Crickets. And from when you send out an email that basically the lifespan of it in terms of your list is about 2 days, right? It takes about 2 days for most people to filter through, and then it's just almost no traffic going through. So I think I had 1 or 2 sales off of that email in the first couple days. And then I picked up the remaining, it sold out at 30, right? I only wanted 30 in the group just because I'm giving personal attention. Well, it's like a founders group, a beta test group, and I want to work with people closely. Mm-hmm. So I limited it to 30. So the remainder of the people just found it by stumbling on it.
Interesting.
Yeah.
Well, I mean, that says a lot for your organic traffic. I mean, I'm sure you have a lot of people that just come and just kind of peruse and go through the content and.
Yeah, well, I mean, I think the list will convert too. I just didn't do it right. I mean, a lot of the people I asked, did you even see it in the newsletter? Because some of the people that found it were on my newsletter list, right? And they're like, no, I never even saw it. I never even knew the offer, so it was just so buried in the article, nobody could even see it because I was just trying to be low key. I was worried too many people would convert. Huh. And then it went crickets and I was worried it was going to be because I was only taking 30 people, right? So I was like just trying to bury it and hide it and just see if I could keep it small. And then it was crickets and I thought, oh my gosh, I am so off base. Like I just blew this. And then every day there was 1, 2, 3, no day 4, it's just like they just kept trickling in day after day. And within a week and a half, it was sold out. I was like, whoa.
Nice. So let's give like a lesson for somebody that looks at this and says, I'm a financial advisor, or maybe it's not financial related at all, but I want to build an authority site with content. What was the biggest challenge that you've had in building this, the site traffic specifically? And what kind of suggestion would you give somebody that's maybe starting something similar?
Well, content marketing is the best way to go, but it's a long game. Mm-hmm. Do not kid yourself that you're going to go produce some epic content and it's suddenly going to surface up and, you're going to be on the map. There's a few guys that can do that, but they're extremely rare. And they do some incredibly, they get some lucky breaks and they hit a few key people with large audiences and they're incredibly good, right? They're just really good at what they do. For most of us humans, it's a long game, and it's been a long game for me. I've always wondered where that big break's going to happen, right? And instead, it's just relentlessly brick by brick by brick. It's just relentless persistence.
Mm-hmm. Yeah, I agree. I mean, the SEO/content play is long. You've got to put in the time, and it's not like an overnight thing for sure.
Well, and just building an authority site. I mean, you're building authority. That's a massive network of links and people talking about you, and you have to produce good stuff or people won't want to talk about it or link to it. So it's a lot of work to produce good stuff and give it away for free. It's a tough game. The whole internet riches thing, it's real, but don't kid yourself. It's not simple. It's not a quickie. It's not get rich quick. It's hard work.
Yeah. I completely agree. I want to turn our focus back to the markets real quick and just see if you have any forecasts or predictions, and I'm not asking like, where's the Dow going to be in a year, but as far as asset classes go, because it seems like you're a guy that's pretty good at timing. You timed when to get out of the hedge fund, you timed when to get out of real estate. Do you see any big kind of 5-10 year moves or shifts that you think would be good for people to either get into or get out of?
Okay, this is a fun conversation. First of all, let me preface everything with, I don't bet a dime on my own forecasts. Okay, all my money is at risk on quantitative work with disciplined risk management. So anything I say today could, be inconsistent with a position I actually have in the future. Okay. Or it could be consistent with it. So I'm giving my honest beliefs, but I just want to be really clear that I have quantitative risk management behind everything I do, and I could be in or out of a position at any point in time. So with that said, I don't forecast anything in the sense that none of my work requires a forecast. That's one of the 10 tenets I teach about how investing is done properly. Any investment strategy that requires a forecast is by definition invalid in my world, because the future is unknowable, right? And if the future is unknowable, then you can't do it.
So based on statistics, based on
Yeah, so that's what I'm going to
and
do.
stuff
That's
like
what I'm
that.
going to do. But I'm trying to preface what I'm saying so people really understand where I'm coming from here. So, with that said, okay, there's one really interesting asset class, which is gold and gold stocks. And the reason for that is they got 5 consecutive down years, depending on the index you look at. There's down anywhere from 85 to 90%. I mean, I might be exaggerating, anywhere from 80 to 90% at the lows, depending on the index you look at. And the other key thing is 5 down years. There's only one asset class that's had 6 consecutive down years, and that was coal. And that was that 6 year preceded a very long bull market.
Hmm.
And that ties in with a whole nother thing that's very interesting. The whole world right now thinks that, buy the dip, buy the dip. Like you hear it right now in the markets. We're recording this on January 26th of 2016. And we've had a nice little downturn in the first part of January, and everybody wants to buy the dip. I have no idea if we're off to the races again. If the federal government has yet another QE rabbit to pull out of their hat to prop things up one more round to artificial new highs or not, I can't forecast that, right? That's government intervention. I don't know.
Mm-hmm.
Um, but what we do know is the market's in the top decile of valuation, at least now, and it was in the top 6-7% near the highs. And that precedes, that's a setup for bear markets as well as a setup for low compound returns over a 10 to 15-year time horizon. What happens is we're in a world where everybody thinks they should buy the dip, and they're trained to do that because the government comes in and bails out every decline
Mm-hmm.
with lower interest rates and fiscal policy or monetary policy, whatever. And so I always look for the thing that nobody's looking for, that is not just plausible but actually likely. And the thing that strikes me that no one's looking for that's not only plausible but likely is inflation.
Mm-hmm.
If we actually got inflation, I have no idea if we'll see a deflationary collapse before an inflationary rise. But given that the government's hell bent on creating inflation, it's just a question of time till they succeed and in what form. And when you get inflation, now they don't have the power of lowering interest rates because they control the short end of the curve, but they don't control the long end of the curve, right? And so the long end of the curve is not government controlled, it's market controlled. And so I look at that and I go, that's a way in which valuations could move permanently lower. Is right in a rising interest rate environment, if you go from stable low inflation with stable low interest rates to a rising interest rate environment, that's a way in which you could get a downturn that stays down. And it's also an environment where you can get fundamental shifts in what asset classes become the dominant asset classes. And so anyway, that's the same thing I looked at before I exited real estate.
Mm-hmm.
You can look at just an insane relationship of supply and demand. Like, I cannot believe that little downturn that we had in the beginning of January. It was greeted as a buying opportunity almost universally by the public and by the media.
Yeah. Well, if you look at the past several years, every single dip has been met with a V bottom. And my whole attitude towards that was, well, it works until it doesn't, right?
Yeah.
But I think, thinking of the markets in a broader perspective, you do have to consider all those things that you were talking about, like government intervention and, interest rates and potential for inflation. So it's
Yeah,
really
they can have another rabbit out of the hat. They can kick the can down the road again. There's none that says they can. I never would have guessed they'd be this successful kicking the can down the road, but there's going to be a point at which, they're going to try to kick the can and the can doesn't move.
Yeah. So
And
do you
when
think
that
there's going to be a
happens,
flight back into gold, or do you see something else,
well, I
possibly
don't
with
do
digital
anything from
currencies or something crazy?
Yeah, I don't do anything from a fundamental standpoint. I mean, everything would be supported by the math and the methodology. I'm just giving you, like, I'm as intrigued by all this stuff as anybody. So I'm telling you how my mind looks at it and how I'm intrigued by it and the scenarios that I see, but I don't put a penny of risk at it until pieces come together and the position is established.
Yeah, and just so for anybody that's listening to this, like most of the audience knows that I'm in agreement with you on that I like to fully test and really quantify any investment that I make. But it is kind of fun and interesting, I think, to maybe speculate a little bit and just kind of weigh the possibilities and the probabilities of what could happen. But that doesn't necessarily mean it. And this is where I think a lot of people get this wrong, is they forecast, right? They have a prediction, and then without any other data backing it, they put money on the line, they risk it. And then, I think that's why a lot of the talking heads on CNBC are, coin flip. Hardly any of them are actually accurate because they're just making forecasts and predictions based on guesses.
Yeah, I haven't watched CNBC in years and years and years. I mean, it's just, to me, it's financial porn. I don't,
Yeah.
I don't I don't have time to waste on that kind of stuff. But yeah, so there's a relationship between valuation and drawdown, and there's a relationship between previous drawdown from highs and mathematical expectancy over a meaningful time period of 5, 10, 15 years. And so, you've got some really interesting setups here, and you've got really polarized thinking within the investment community. And so I think we're in a very interesting setup. I have no idea, though, if they're going to kick the can down the road one more year or not. But as far as I'm concerned, they kick this can down about as far as they can. But they've surprised me so far. Maybe they'll kick it one more time. I don't know.
Interesting. Well, thanks for your perspective on that. Now it's time for 5 to Thrive. Basically 5 questions that can help our listeners understand how you built your business and, how to build wealth from your perspective. So the first kind of thing that I want to ask, and this might be a little different for everybody, is, are you in the camp of you got to focus all your efforts on one thing, or diversify and have multiple streams of income?
Both. I'm a classic economist, right?
Yeah.
So in order to create something, you have to focus. But then once you focus, then it opens up avenues to diversified sources of income. But the initial game plan, you want to focus and become such an expert at something that's so valuable to others, they'll gladly pay you for it, and they'll pay a premium for you because you're the expert. So you want to delve and become the expert, the go-to person in a chosen field that has value. Don't, as Sonia Simone over Copy Blogger says, don't become an expert at naked mole rats, right? Nobody's going to pay you for it. But if you become an expert at specific programming techniques, or marketing or copywriting or whatever that is, and you become the go-to guy, command good income for it, and then you can figure out multiple streams of income off the back end of that once you're a highly paid, highly skilled, highly valued person.
I love it. What book would you
by the way, I actually have an article on my site called Multiple Streams of Income Revealed, and it goes through that whole explanation of how it works if people want more granularity in it.
Nice. I'll go ahead and link that up. Multiple Streams of Income Revealed. Cool.
Yeah. So what I do is I try to debunk the traditional approach to multiple streams of income. Everybody thinks they got to go out and suddenly get great at business and real estate and paper asset investing, and they got to build all these income streams, and they get their business, they're going to do 14 income streams in it and diversify and all this. And it's like, no, it's not quite the way it works in practice.
Mm-hmm.
And so it goes through and it explains that, yeah, the principle's there, but you got to apply it in a certain way for it to work.
Mm-hmm. What book would you say is required reading for investors?
Required reading for investors? Well, the book I write eventually, but it's not out yet. I look at investment reading because there's so much that is wrong in so much stuff that I look at it as you can see in the back here, right? You can see the bookshelves.
Mm-hmm.
Those have been emptied a couple rounds and they just keep filling up. I've literally sold hundreds and hundreds of books on eBay. I sell them by the case. So to me, if I can get one good tidbit or one good idea out of a book, I consider it a success. Mm-hmm. Is there one book I would recommend? No, I can't think of one. If you ask me for an entrepreneurship book, I could give you one of those.
Let's go with that.
Okay. I recently read Essentialism by McKeown. I can't pronounce it. McKeown. I thought that was excellent. Another one that I love is The War of Art by Stephen Pressfield. That one's brilliant. So those are 2 good books, not traditionally considered in the world of entrepreneurship, but they're dead on.
Yeah. Typically it's the ones that aren't like obvious, that are the best for entrepreneurship or investing. I think a lot of entrepreneurship books can translate into investing, especially a lot of like the mental side of things, like Trading in the Zone or The Mental Game of Poker. I think those types of things apply in both industries.
Well, The War of Art is all about dealing with your resistance, overcoming your personal resistance, which everybody confronts as they try to move their life forward. I deal with it in coaching all the time with clients. I deal with it with myself. I'm dealing with it right now. I'm building out this course. Even if I teach it, I'm not immune to it. We all have to have it. Or we all deal with it. We all confront it. And then the essentialism, it's all about, in today's society, there's more opportunity and more things than we can handle. And so it's all about boiling down to those most essential things that make the biggest difference.
Nice. I love that. Keep it simple and get rid of all the noise.
Yeah.
Do you have a favorite quote or a mantra that you tend to live your life by?
Yeah, actually, let me read one from here. I'm gonna have to look to the side. My the monitors over here. I
Sure.
love this one by Andy Warhol. Being good in business is the most fascinating kind of art. Making money is art, and working is art, and good business is the best art.
Nice. Love
Yeah, I
it.
love that one. I've got several more on the monitor if you want more, but that one's probably a good one to leave you with.
Yeah, that's a great one. Final question. What does true wealth mean to you?
True wealth is about freedom and fulfillment. It's not really about money. No one sets out because they want more money. What they want is what they think money will give them.
Hmm.
And so true wealth is recognizing that the thing you really wanted was freedom in the first place. And the reason you pursued financial freedom is because you projected your desire, that internal value for freedom, onto an external thing called money. And
Mhm.
so when you pursue true wealth, you really own that the value was freedom itself, and it's an internal experience. And how do you create that in your life?
I love it. Freedom and fulfillment.
Yeah.
That's a good place to leave it off. Todd, any final words of wisdom or pieces of advice for somebody that wants to become either an entrepreneur or an investor? I know we kind of hit it from both angles today, and we jumped back and forth quite a few times, but any final thoughts that you want to leave everybody with?
Yeah, life's an adventure. Go live it. I mean, I said it early in the interview. The whole reason I'm doing financial mentors, I wasn't okay taking it to my grave.
Mm-hmm.
I wanted to give it a shot. I wanted to go for the adventure, bumps, bruises, and all, right? And so life's an adventure. Go live it. You're going to die anyway,
Yeah,
right? So why not just go for it?
absolutely. I love it. Todd, where can people reach out to you? Obviously, financial mentor. Anything else?
No, that's it, man. Financialmentor.com is my hub. That's more than enough. That's focus, right? We talked about focus.
That's it.
So anyway, that's my hub. That's what I build, and that's where everything is. And you can find social media profiles from there, but my focus really is the site. That's what I love.
Cool. So we'll link all that up, guys, in the show notes. Todd, thank you so much for being on the show. I know people are really going to get a lot out of this. You definitely have a wealth of knowledge and have been in a lot of different industries, from trading to real estate and now internet businesses. So I love it.
All right. Thanks for having me on the show, Chris. Really enjoyed talking with you.